Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have someone very special where you can learn what you need to do, what it takes to get a good loan on a bigger property, on a commercial property, on a multifamily property specifically. So we have Anton Mattli. Anton has more than 20 years of capital markets experience, including commercial and investment banking, private equity, and commercial real estate. He's advised family offices, high net worth individuals, as well as private investment funds with investments in commercial real estate across Europe and the United States. He currently works with Greysteel as Senior Director of Debt and Structured Finance. Anton, welcome to the show.
Yeah, good morning, Juan. Nice to see you.
Hey, thank you so much for taking the time and being here with us. And so let's get this show started. Why don't you tell us where you're calling us from and fill us in on your background a little bit?
Sure, I would love to. As you can hear, I'm not from East nor from West Texas. I was born in Switzerland. When you are in Switzerland, you have some industries that we are well known for. One is chocolates or our watches, and a lot of people get into finance, and that's what I studied. After school, I joined UBS. It was back then, actually, it was called Swiss Bank Corporation, but they merged in the late 90s with Union Bank of Switzerland, which today is now known as UBS. And I was lucky enough to be invited to a management program that they organized in New York City. And so basically there, I learned everything that they didn't teach us in school about banking and finance. And after 6 months of pretty tough training, they've offered us a job, and I was again lucky enough to get a job in New York City. So I worked there for roughly 5 years. After that, I went to Japan, to Tokyo for 4 years, over to Hong Kong for 3 years. And after that, I left and helped a couple of family offices with their direct investments, a lot of them in commercial real estate and oil and gas. That was the reason why I then came to Dallas in 2004 and helped these family offices with their investments in commercial real estate and oil and gas all across the United States. And we liquidated a big chunk of that over the years. And a few years ago, I joined Greysteel to help them build out their debt and structured finance team.
Nice. No, that's a big experience background for sure. So, yeah, we should be in for a treat because, you should be able to help us out a lot with a lot of the questions that we have and my listeners will probably have as well. So let's get started with, tell us what loan products do you usually work with here currently today?
Yeah, so multifamily, we obviously focus a lot on agency debt, right? That's one of the beautiful things about multifamily investing, that you have access to both Fannie and Freddie loans. You also have HUD loans for some of the larger deals. They're a little bit trickier to get, but have very long terms. But for most multifamily borrowers, I would say Fannie and Freddie are the go-to programs. They have a variety of terms from 5 years to all the way to 30 years. Most use 5, 7, 10, and 12-year terms. The beauty about these programs also is that you have non-recourse financing. You still have the bad boy carve out. So if you commit fraud or gross negligence, you are not protected as with every non-recourse loan anyone is providing. But it's at minimum what the benefit you're getting is that you also have a virtual unlimited borrowing capacity with that non-recourse offering. So you essentially, if you go with a recourse loan, a lender will eventually say, well, I think we have enough of an exposure with you, and other lenders have the same problem. So you're limited with the amounts that you can borrow, whereas with these non-recourse agency loans, you have essentially a virtual no limit to borrow funds.
Yeah, no, that makes a lot of sense. So,
Yeah.
So how do we qualify for one of these loans? They're non-recourse, so which means that, the bank shouldn't come back, to you in case, in the event that something, goes down south, right? Unless, you commit fraud, right? Like you said, the bad boy carve out, but right. What are the qualifications for us to be able to get one of these loans?
Yes. So some of the key qualifications, maybe we can start with the small balance Freddie, which is really the first one that usually a borrower steps into, which is easier to get as a new entrant into the multifamily space. It's actually relatively easy to qualify for that program. It starts at $1 million of a loan amount. You can go as low as 700,000, but usually it's the official program minimum number is 1 million, and it goes up depending on the market to 6 or 7.5 million. The qualification for that is that you either have already a multifamily experience or you hire a professional third-party manager that manages that property. So you can apply for that loan and get that loan without prior multifamily experience. So that's the beauty about these small balance, about that small balance program. With the Fannie programs and the conventional Freddie, it's a little bit different. There they expect that you have already multifamily experience for a similar type of property that you are applying for. So just because let's say you have a 20-unit property and now you apply for a 150-unit property loan, that would not really qualify you for a Fannie loan. So it has to be similar to the property. But what you also could do with a Fannie loan is that you bring in someone else as a co-sponsor or a guarantor who has that experience already, and you basically can piggyback on that individual's experience and have the ability to get a Fannie loan too. But again, for beginners, I would say the best really is to start out with the small balance Freddie, which is an excellent way of getting into the multifamily space.
Okay, so for the small balance Freddie, like you mentioned, those are a little bit easier to qualify for. So if let's say I have 20 single family homes, or experience with 20 single family homes, or even like a 10 to 15 unit multifamily property, will that allow me to get to that the next step and qualify for one of these small balance loans? Is that good enough?
Yes, it is. It happens actually quite a lot, where individuals start out with single family, right? They may have started out with wholesaling or flipping, and then they start renting the properties and build a portfolio of single family homes. Very often there might be 5 or 10 properties, and eventually they decide, I think I want to give the multifamily thing a shot. Obviously, there is a lot of information out there that explains why multifamily is a good option compared to single family. So they investigate this, start making offers on these multifamily properties. And we have been qualifying these single family owners for Freddie small balance programs all the time. So works perfectly fine. What is important is that you still have a third party manager, or that you are very close to the property. So sometimes it can happen. Let's say if you are in Dallas or in Houston or in another market, and the property is very close to where you live, and you have already owned and managed your own single family portfolio close by, you may be able to qualify as a owner manager. But generally speaking, the Freddie small balance program really prefers that you have a third-party manager. Frankly speaking, in most situations, it's a better choice anyhow, because it's a different type of qualification that you need to manage multifamily property compared to a few single-family homes.
Yeah, that makes sense. It's better to have the property manager to be on your side anyway, and it also gives you a better resume going in. When you're trying to qualify for one of these loans. So, what is the maximum loan amount for the small balance program? And then when do you have to go to the conventional, Freddie or Fannie?
Yes, depending on the market, it's 6 million to 7.5 million. Also, it depends a little bit on the property size. So in a market like Dallas County, which was just recently upgraded to a top market, as Freddie calls it, you can go all the way up to 7.5 million for properties that are 100 units and less. But as a general rule, across the country, it's up to 6 million.
Got it. Yeah. So what about, whenever you actually go to sign on the loan, can you borrow in your own personal name, or does it have to be an actual entity?
You can borrow in your name. You can borrow in various type of entities, including trusts, LLCs, partnerships, as well as in your own individual name. Generally, it's not recommended to do that also from a liability perspective. The lenders allow it to do it, but they certainly prefer to have a so-called single purpose entity or single asset entity that owns that asset. In most cases, particularly because it's so cheap to establish an LLC, in most cases, all the individuals will borrow under that special purpose entity's name. And sometimes they have to do it with a trust if they have it under a trust. But we seldomly see that an individual wants to and actually borrows under an individual's name.
Okay, got it. So let's talk about the Fannie Mae program and also the Freddie Mac. Can you tell us the differences in when or why you should go with one or try to go with one versus the other, or kind of fill us in on that a little bit?
Yeah, so as long as you're with the small balance program, Fannie also has a small balance offering. It is from 1 million to just 3 million. So it's not as broad as the Freddie small balance program. Sometimes that's actually not a bad program to get into. Under the 50 unit mark, they also offer the so-called step down prepay. Above the 50 units, they do not offer that. So that's one of the big disadvantages of the Fannie program. Once you get above that 50 units in the small balance program, once you get into the higher loan amounts, the so-called conventional programs, both on the Fannie and Freddie side, they really have very similar programs. They do not have standardized documentation as a small balance Freddie has, which makes it easy to review the documentation. So if you have done one small balance Freddie, it's the same type of documentation and process from transaction to transaction. Whereas with the Fannie conventional as well as Freddie conventional, you have many more options there. You also have many more flexibilities that can be implemented. So with the flexibility, obviously, you also get higher complication of loan documentation, and with that you also have usually higher legal costs that is associated with it. It's not drastically higher, but it's still higher than for the small balance program. One of the big differences, particularly between the small balance Freddie and then the conventional Fannie and conventional Freddie, is that you have no longer the step-down prepay option that the small balance Freddie is offering. Small balance Freddie offers also a so-called yield maintenance to lower the interest rate, but at least you have an option to get the step-down prepay. When it comes to the Fannie, conventional Fannie and Freddie programs, you are limited in most cases to the so-called yield maintenance or defeasance type of prepayment penalty. which makes it much harder to prepay financially, much harder to prepay the loan earlier. It can easily go into the hundreds or millions of dollars. But one of the advantages you have then with the Fannie program is that you have the ability for a new buyer to assume that loan, but also to add a supplemental loan on top of that when that buyer is assuming the loan. Whereas with the small balance Freddie program, you also have the ability to assume the loan, but there is no program that is Freddie supported that allows a supplemental. So in most cases, whenever there is a sale of a property with a Freddie small balance loan, the seller usually prepays that loan so that the new buyer gets a brand new free and clear loan.
Got it. Tell us what exactly is a supplemental loan for those of the guys that don't know exactly what that is.
Yeah, so it's like a second mortgage. A lot of you listeners are familiar with on the single family space, right, where you get your first mortgage and then you get your second mortgage. That's what essentially the supplemental loan is. It's a second mortgage that is part of the Fannie or Freddie conventional program. And it allows you to get up to 75% of the value of the property value at the time of purchase. So it's not when it was originally purchased by the seller, but of the new value as determined at the time of the purchase. So it's still a relatively high leverage that you're able to achieve as a new buyer when you assume the loan and then add that supplemental loan on top of it.
Yeah, I can see how that can be very beneficial, like moving forward, if you're able to get a supplemental loan. So a lot of good benefits on doing that as well. So how do we qualify for one of these? You mentioned earlier that, that the small balance is a little easier to qualify. I mean, as far as the conventional, we're speaking now, how do we qualify for one of these? What's the net worth requirement? What's the liquidity that we have to have, post-close liquidity and those kind of, items? So what do we have to have?
Yeah, so for the assumption supplemental, it gets a little bit trickier compared to an acquisition because the lender will attempt to get a replacement borrower that is equal or possibly better than the exiting borrower, right? So if you have a very strong seller, let's say institutional owner, and you are, let's say, a syndicator with not so strong guarantor group that comes in, you may have a little bit of a challenge to convince the lender to take you on as the new borrower. But as a general rule, it doesn't really change the requirements, whether it's an acquisition or whether it's an assumption. So you have similar requirements there. Usually, there are some exceptions, but usually you need to have a net worth of the combined net worth of all the guarantors that is equal or higher than the loan amount. Also, as a general rule, that your post-closing liquidity, so right after you close or at the time of closing, that your liquidity is around 10% of the loan amount. So if you have a $10 million loan amount, it will be roughly $1 million. If it's a $1 million loan amount, it will be roughly $100,000 in post-closing liquidity. The small balance Freddie program has a little bit of a different approach there, where they say you need to have 9 months of principal and interest. So usually that's less than 10%. But I would say, as a general rule, I would use that 10-10 rule because that's easy for everyone to understand. And frankly speaking, also from a sponsor perspective or buyer perspective, I think it's really advisable to have roughly that 10% in post-closing liquidity anyhow, right? So that you're not getting under financial distress if something happens.
Yeah, it's highly recommended that you have that anyway, and then they make it a requirement. So yeah, that's good that you could talk about that. So let's go over the Fannie Mae Green program, and from my understanding, Freddie Mac has one of their own, which is called the Green Advantage program. So tell us a little bit about those and what do you have to do to how does a property qualify for one of those?
Yes, but both of them have these programs. As you mentioned, it's the Green Rewards, Fannie, and then the Green Advantage, Freddie has. So they're pretty similar. Until last year, Freddie made it a little bit easier to qualify for it because you only had 15% of savings in water and or energy cost that you had to prove. Also, Freddie allowed up to 2 years of implementation of these costs savings. Starting this year, it has changed. So now both of them have 25% of savings requirement. Freddie still requires $350 per unit of actual spend for these energy savings to be implemented, whereas Fannie doesn't have that rule in place. Fannie requires that these cost savings implementations are done within 1 year. Freddie allows you to do it within 2 years. So these are the main differences there. So not significant, really. Interest rate savings-wise, they are also very similar. So you would see savings somewhere in the 10 to 20 basis point range. We have seen sometimes that they can go all the way up to 30 or 35. The largest that we have done was 33 basis points. But I would say expect somewhere in the 10 to 15 basis points range. And if we have a strong borrower, a strong story, then we might be able to get a higher amount of savings that Fannie or Freddie approves.
Yeah, so if you're able to implement one of these programs, you're able to, in turn, save a lot or save a good amount on your interest rate. So your costs, as far as these programs, if a program was done maybe, let's say 5-10 years ago, can you do it again, or does it have to be a certain amount of time before you are able to implement the program again?
Yeah, as long as you can prove the savings, you can do the program again, right? So if you are applying for a loan and you can prove that you can generate these additional 25% in savings, you technically could do it again. The question is whether once you have done it, let's say a few years ago, whether you're still able to repeat it again. I would say on the electricity side, considering all the advancements we have made on air conditioning improvements and lighting with LEDs and all that, that might be possible. If you implemented water savings just maybe a year or two ago, you probably will not be able to achieve the savings. If you implemented water savings just 5 or 6 years ago, it could well be that if, particularly with toilets, that you potentially are able to repeat that again and achieve these savings. One important aspect of these two programs is that you cannot do the savings and then apply for the loan. You have to make sure that you have not implemented these savings yet, which I know sounds a little bit strange, right? You would think that you would give buyers or current owners the incentive to implement it as quickly as possible. But that's one of the tricky parts of these two programs, that you have to apply first before you implement these savings. They have other programs in place for existing owners to get some benefits for existing properties, but they are typically more geared towards the Class A properties that are LEED certified and similar. Right? But for the typical B and C class properties that a lot of our clients are looking at, it's really the Green Rewards and the Green Advantage programs that are most suitable. And again, for those, just make sure that you don't implement these savings until after you have the loan in place.
And so after you have the approval from the programs and the lenders to move forward with it.
That's right, and it's actually can go a step further. If you are an owner and you consider to sell the property, obviously on one hand you want to improve your NOI as much as you can to increase the value so that you can achieve a higher value sales price. One of the disadvantages is if you implement your water and energy savings right before that, yes, your NOI goes up, but you give the new buyer not the opportunity to apply for that green rewards or green advantage loan. So you have to, as a seller, you have to kind of decide what is worth it as a sales pitch, having a higher NOI or giving the opportunity to the new buyer to apply for that green rewards or green advantage program.
Yeah, I mean, that's a tough choice to be in and tough decision because, you want to be able to achieve the most you can out of the property. But then again, you also want to leave a little bit for the next guy, right? So like that, it kind of becomes more attractive. And so like that, he can implement his own program and move on, right? So that's a great point. So let's talk about what kind of items or what's the things that we can implement and roll into the loan. Can we do like the rehab budget into the loan or a certain percentage of that or closing costs, on like a Freddie Mac, Fannie Mae kind of program? What can we do there?
Yeah, the small balance Freddie, it's a great program, but that's one of its disadvantages where you're not able to roll in any rehab cost. You can roll in up to 3% of your closing costs, but unfortunately, none of the rehab budget can be rolled in. That's a big advantage of the Fannie program, and we have seen that over and over the last few years, where properties are bought with a rehab plan in place. And Fannie regularly is willing to roll that rehab program into the loan. Today, depending on the market, it's a little bit tougher, particularly in markets like Dallas and Fort Worth, where typically now you're debt service constrained rather than leverage constrained. That yes, you technically could roll in your rehab money, but because you are debt service constrained, you do not really have the ability to roll in both the purchase price and the rehab money, or only a portion of it. If the debt service coverage allows it, you can go, usually it's around up to $5,000 in rehab money that can be rolled in, but we also have done loans that covered more than $10,000 in rehab money. It's unusual. Usually it's in the $3,000 to $5,000, but again, if the story is right, it actually can be pushed up to a higher level. But again, it depends on the market you are in. If you're in a market that is booming, and you have a big buyer pool, it's harder to get to the maximum loan proceeds because of the debt service coverage constraint.
Yes. Now that we're on that subject, what is it? What is the service coverage constraint that we? I mean, what is a DCR? What are we looking at there? Is it 1.25? Is that what you usually look for, or what is it?
Yes, sometimes it's 1.2 in some instances, like for the top markets for the small balance Freddie, but for the Fannie program, in most instances, you have some exceptions for the affordable loan program. But when we look at the most common program that is being used, the Fannie program that is used for most of these B and C class properties, it's 1.25 of the underwritten NOI. And that is also an important point to highlight. It's underwritten by the lender and not the pro forma by the borrower. It's not the historical numbers. It's not whatever is written in the OM. It's it's how the lender underwrites the loan. Right.
Yeah, that makes sense. So we're talking about 1.2, 1.25 for debt service coverage ratio. whenever you roll in the rehab costs, does that still apply or not?
Yes, it does. So if you have the ability to roll in the rehab money, and let's say in an ideal case, you get 80% of the purchase price plus closing cost plus the rehab money, that 80% would still have to cover at 1.25, right? So if you are not able to cover it at 1.25, then the loan proceeds will be reduced to an amount that would allow that 1.25 coverage.
Yeah, that makes 100% sense. Okay, well, great, awesome. So let's get into our nuggets of wealth, Anton. So let's get into these. These are questions that I ask every guest every week that can help others, in their journey to get it to the next level. So, what is a key tip or advice that you would get to others who are looking to get started or take their business to the next level?
Yeah, I think the most important piece, particularly if, a lot of listeners, right, they are in single family now. They have been able to do that all on their own, maybe with their spouse or with their partner. So it's kind of being a sole warrior on the ground. With multifamily, my biggest recommendation is just don't do it. Right, multifamily, it's a team sport. You need to bring in partners with different strength. Even as sponsors, I would strongly recommend to partner up with someone who has already done it. And even if you partner up with someone who hasn't done it, at least find someone who has different type of strength than you do, whether it's numbers versus talent to find properties and negotiate, whatever it is. So as a sponsor team, I strongly recommend to combine the strength. And then when it comes to partners, it's extremely important to find the right contractor that comes out with you to look at the property, to identify some of the items that need to be fixed. It's much more involved than for a single family property. Also, when it comes to the property management, find a property management company, interview them well before you start the process. Us as debt brokers, obviously, we recommend that you reach out to a broker. You can go out directly to lenders. I would strongly recommend, and that's not just self-serving, really. I would strongly recommend not to do that. When you approach brokers, they do deal with lenders all day long. They have relationships with them. If there is a problem through the process, they can help you to solve that problem. And that really applies to every single service provider that you choose, that they are there. The insurance broker, it's the same thing. Pick a broker that has the experience in that multifamily field. Right? Just because someone is in the single family field doesn't mean that they have an understanding of insuring multifamily properties. It's a much more complicated process. There again, pick the right partners and really approach it as a team sport. That's really my biggest recommendation.
Yeah, no, I really like that because, it is a big difference with going from single family to multifamily. Like you mentioned, single family, you can do a lot of it on your own, and multifamily, you won't get very far if you try to do everything on your own, and you really do have to leverage the experience of others and have a great team around you to be able to succeed. So, yeah, those are great points. So, what is a good tool, source, or platform that you use frequently that can also help others, Anton?
Well, we live every day with some of the pay tools that we subscribe to. Usually your listeners would typically not have access to those, right? It's Yardi Matrix, it's CoStar. These are tools that we use on a regular basis. But I would say establish relationships with your brokers that sell properties or with a debt broker. And if you have a deal that you are really interested in, that you already have underwritten and feel this is what I want to give a shot at, reach out to these broker relationships, ask them for a Yardi report, or ask them for a CoStar report on that property, so you can piggyback on that information that they have themselves. One of the tools that I use outside of that, it's a free tool all the time, particularly when I'm on the road, is a mortgage calculator that is an online calculator specifically for interest only. I can send you the link. I think it's called, let's see here. It's called calculatestuff.com.
Okay.
And so they have a financial interest only calculator there that's really easy to use. And I would strongly recommend that whenever you analyze a deal, always run that calculator, right? If you have a spreadsheet, you already have that, but very often when you are on the road and you do back of the napkin calculations, you may not have access to your spreadsheet. So that is something that I use all the time, even though I have access to spreadsheets and more sophisticated tool, but it's an easy way to always quickly identify what the principal and interests are, and also what the balance would be after, let's say, 3 or 4 or 5 years, which gives you an idea of how much you were able to pay down for that property if you held it for, let's say, 5 years.
Awesome. So that was calculatestuff.com?
Yes, that's correct. Yeah.
Yeah, so that's a great tool that I'll be checking out as well. So thank you very much for that. So where can Commit to Wealth Nation go to find out more about you and Greysteel?
Oh, sure. So again, my name is Anton Mattli. You can reach me at amattli at greysteel.com. So that's AMATTLI at greysteel.com. You also can reach out to me by phone. That's 469-518-5462. And you can also text me on my cell phone, 214-534-3647.
Okay, awesome. So definitely reach out to him if you have any questions regarding any kind of financing on these commercial properties. He's very knowledgeable, and I will tell you that personally, because I have personally worked with him and asked him many questions, and he was very helpful. So well, thank you very much, Anton. I appreciate your time. I appreciate you sharing your knowledge and your experience with my listeners, and I wish you continued success.
Yeah, same to you. Thanks, Juan.
Okay, well, thank you very much.
Yeah,
okay.
Bye-bye.